Okay, let's see how we're doing here. We're going to talk about the fact that although we've been saying all along that S corporations are not taxed because they're not tax-paying entities, there is certain circumstances where they are taxed. We learned about that in the last video when we talked about the concept of if there is taxes where it was a C corporation that had E and P, and then it became an S, that's where it could happen. So actually we're going to learn one for this course, and that'll be what's called the tax on built-in gains, because that's an important one because the acronym is big. So that's why it's an important one. So let's see what this tax is, but before we do that, let's understand how S corporations liquidate, what kind of tax effect happens when they liquidate. We learned when C corporations liquidate, you'll remember this, because you're probably blue in the face remembering it. When C corporations liquidate, it creates a deemed sale right here at the C. And so there's a tax paid by the C corporation on this deemed sale. So here's one tax. And then the shareholders over here, when they get the liquidation, they pay a tax on what they get, tax number 2, hence 2 taxes. So a clever tax practitioner, meaning a CPA, they're the clever tax practitioner, says, hey, I got an idea. Why don't we take a C corporation and make the election, check the box, to become an S corporation. Remember, check the box. Check the box. All right. Now, why does that work? So that we have to understand, and that's what we're getting to. When an S corporation liquidates, it actually follows the same rules as the C corporation. It actually follows the same rules as the C corporation, and that is that whatever its fair market value of assets are, it recognizes that fair market as a deemed sale, just like the C corporation, deemed sale. Okay, so far so good, I suppose. So it looks like you're going to have a double tax, but wait. The deemed sale causes you to have gain at the corporation, hence income, but there's no tax to pay here because it's not a taxed entity. No tax to pay. At least not at the corporation. Yes, there's a deemed sale on the liquidation to the shareholder. And we're going to compute a gain, and that gain's going to get sent over to the shareholder vis-a-vis, you guessed it, the K1. But there's no tax at the corporation level. Yes, the shareholder will pay the tax, but it's the same solution that we were looking for with the C corporations in general, only tax one time. That's it. So, back to our clever CPA. Our clever CPA with the C corporation says, well, wait a minute. If I liquidate as a C corporation, I'll have tax number 1 here and then a tax number 2 over at the shareholder level. I don't like that. So I know what I'll do. I'll check the box. That's where we're going, and I'll become an S corporation, and then I'll liquidate, and there'll be no tax here, and it'll just go there, and it'll be 1 tax at the shareholder level, and that's it. Isn't that a great idea? So tax law says that is fine. It's following the rules, except you got a big problem. You got a big problem, built-in gain problem. And the built-in gain is essentially what was up here that was going to be subject to double tax, and now you're trying to get clever and hide it and not get taxed on it twice by making the S election. So the built-in gain rules basically say, okay, you got to wait a certain number of years, and then we'll act as if it really is an S corporation like this, and we won't have it taxed twice. You got to wait a certain number of years before the built-in gain goes away. The certain number of years is 10, and what this all means, let's take a look at an example of the built-in gain rules, and that would be the following. If the C corporation had, at the date that it made the check the box, there you go. Notice the sound effects when we check the box. At the date that the C corporation checked the box to be an S corporation, if the C corporation had liquidated at that point in time, what would the gain be at that date on the deemed sale? What if the corporation had liquidated at the date of the election, at the date of check the box, and there we'll do the sound effect again, whatever that gain was or would have been, that gain stays down here subject to taxation if we liquidate. It's only an if we liquidate, that gain stays down in the S corporation for that 10-year period. And if the liquidation happens in the 10-year period, then we go back and say, okay, to the extent that this gain, whatever it was at the date, whatever it was back here, the S corporation on liquidation has to be subject to two taxes. So the S corporation will have to pay a tax as if it was a C on that gain, as if a C corporation just on this green gain over here. That's to avoid the clever tax practitioner from, you guessed it, checking the box, becoming an S corporation down here, then liquidating to avoid the double taxation had it been a C. So the tax code basically says, all right, we'll let you do that if a 10-year period passes, and then we won't tax you as if you were a C corporation. We won't look at the gain at the date. Remember, it's the gain at the date of checking the box. Okay, so it's at that date. That's what the built-in gain is designed to do. Let's see a little bit more about it, and then we'll conclude. So this is a recap of what we just discussed. When a C corporation liquidates, its gain is effectively taxed twice. We went through that again until we wanted to throw up because of the double tax. S corporations avoid it, and we'll get to this part in a few minutes. Don't worry about it right now. Main thing is to discuss the big tax, the built-in gain tax, to discourage C corporations from electing S corporations. To avoid it, the built-in gains tax was made in 1986. Tax only applies to built-in gain assets disposed of in a taxable transaction, meaning sold or liquidated. Sold or S corporation liquidates. And the 10-year period begins on the date the corporation did what? Check the box. Okay. Now, the interesting thing about this is that this 10-year period has now been changed to 5 years. So now we need to learn something new. We got the general principle at 10 years, now we need to know it's 5 years, which is good. Makes the opportunity to do this clever transaction even better. Waiting 10 years was a long time. Maybe we can still do the following. Maybe we can still do the, you guessed it, still do the check the box, C to S, thinking that we might be selling, because this doesn't just apply to liquidation, it also applies to what if we sold the C corporation, sold its assets, That's subject to a double tax. So now we only have to wait 5 years. And the situation really works out like this. You got a taxpayer comes into your office, they're a C corporation, and they're telling you they're thinking of selling their business soon, and you told them that it's going to be subject to tax 1 and tax number 2 based on the double tax, and they start crying. What do? So you make the election to be an S, but you tell them you're going to have to wait. That's right, 5 years to avoid the double tax in total. Now this double tax is again only based on the gain at the date of the election, only based on the date of when you check the box to be an S corporation. So there could be gain that happens in between the date of the election. So here's the election here, and let's say at that point in time on a sale or liquidation, the gain that existed was $10,000, but over time, now that everything appreciates and there's a $20,000 gain, the big tax is only subject to the $10,000 originally at the date. The additional amount is not going to be subject to double tax. So here the additional amount is no double tax, just one. Pretty complicated, but pretty cool. All right, let's see what happens if we go forward. All right, this tells you that the new period is 5 years. Here's an example, and I'll tell you what, let's do one more, and that way we break this up into nice little chunks, and we'll finish it here.